who can actually afford a $500,000 house in 2026. A $500,000 house sounds expensive until you realize it's now the median home price in 57 American cities. Not luxury markets, not coastal elites, regular cities where regular people are supposed to live regular lives. And if you're wondering whether you could actually afford one of these homes, the math is about to make you either very angry or very motivated. Your parents bought their first house on a single income while your mom stayed home with the kids. You and your partner both work full-time with college degrees, and you're getting outbid by cash offers on starter homes. Something broke in the housing market, and nobody's talking about the actual numbers that determine who gets to own property anymore. According to recent mortgage data, you need roughly 3 times your annual household income to comfortably afford a home. That rule held steady for decades, but in 2026, with interest rates where they are and prices where they've landed, that rule just became a fantasy. The real multiple is closer to 5 times your income, and most people have no idea they're not even close to qualifying. Let's start with what banks actually require, not what real estate agents tell you. The standard mortgage approval process looks at your debt-to-income ratio, which means they compare your monthly debt payments to your gross monthly income. Most lenders want that ratio below 43%. Some will stretch to 50% if your credit score is exceptional. But here's what nobody mentions during those pre-approval meetings: that 43% includes everything. Your future mortgage payment, property taxes, homeowner's insurance, HOA fees if applicable, plus every other debt you're carrying. Student loans, car payments, credit cards, that medical bill you're still paying off. Every single monthly obligation gets added up and compared to your gross income, which is the number before taxes eat a third of it. For a $500,000 house, you're looking at a monthly mortgage payment of roughly $3,400 with a 20% down payment and a 7% interest rate. Property taxes vary wildly by location, but let's call it another $500 monthly. Insurance adds $200. We're at $4,100 per month before you've bought groceries or paid for gas. To keep that under 43% of your gross income, you'd need to earn roughly $9,500 monthly, which translates to $114,000 annually. But that's household income, and it assumes you have zero other debt. The moment you add a $400 car payment and $300 in student loans, your required income jumps to $140,000. Most Americans don't earn anywhere near that amount. The median household income sits around $75,000, which means the median American household cannot afford the median home in most markets. The down payment situation makes everything worse. 20% of $500,000 is $100,000 cash. Not financed, not borrowed from your 401k without penalties. Actual liquid cash you hand over at closing. Setting aside $100,000 takes the average household roughly 15 years if they're aggressively saving. By then, home prices have increased another 30%, and you're chasing a target that keeps moving faster than you can run. Some buyers skip the 20% down payment and opt for lower down payment options. FHA loans allow as little as 3.5% down, which sounds amazing until you realize you're now paying private mortgage insurance on top of everything else. That PMI adds another $200 to $300 monthly, and it doesn't go away until you've paid down enough principal to hit that 20% equity threshold. You're essentially penalized with higher monthly costs for not having enough cash up front. The income requirements shift dramatically based on your down payment size. Put down 10% instead of 20%, and your monthly payment jumps by roughly $600 because you're financing an additional $50,000. Your required income increases to $155,000 just to maintain that 43% debt ratio. The less cash you have saved, the more income you need to qualify, which creates a trap where the people who most need lower down payments are the same people who can't meet the income requirements. Credit scores add another layer of complexity that most buyers don't anticipate. Everyone knows you need good credit to buy a house, but the difference between a 740 score and a 660 score isn't just approval or denial. It's the interest rate you're offered. A borrower with a 760 credit score might get 6.5%, while someone with a 660 score gets 7.5%. That single percentage point difference costs you an additional $300 monthly on a $500,000 mortgage. Over 30 years, we're talking about $108,000 in extra interest paid simply because your credit score was 100 points lower. Your total payment to the bank becomes $1,080,000 instead of $972,000 for the exact same house. The property doesn't change, but your financial history determines whether you pay for one house or one house plus a luxury car's worth of additional interest. Employment stability matters more than most people realize when they're applying for mortgages. Lenders want to see 2 years of consistent income in the same field. Switch careers 6 months before applying, even if it's for higher pay, and you've introduced uncertainty into your application. Take a new job that pays more, but includes commission or bonuses as part of your compensation, and lenders will discount or ignore that variable income entirely. Freelancers and small business owners face even stricter scrutiny. Even if you're earning $150,000 annually, you'll need to provide 2 years of tax returns proving that income level. And here's the trap. Most self-employed people minimize their taxable income through legitimate business deductions. You might earn $150,000, but only show $80,000 in taxable income. The bank uses that lower number for qualification purposes, which means your smart tax strategy just disqualified you from the house you can actually afford. The regional variation in housing costs creates wild disparities in who can afford what. A $500,000 house in Austin, Texas, gets you roughly 2,000 square feet in a decent neighborhood. That same money in San Francisco barely covers a one-bedroom condo. In Cleveland, you're buying a legitimate mansion, but salaries don't scale proportionally with housing costs, which means the income required to afford that $500,000 price tag stays consistent while the actual housing you receive varies dramatically. California buyers need the same $140,000 household income as Ohio buyers to qualify for the same loan amount, but the median household income in expensive markets hasn't increased enough to match housing costs. This creates a situation where dual-income professional couples in tech hubs are competing for the same properties as single-income households in lower-cost areas, except the competition in expensive markets involves 40 other buyers making comparable offers. Age demographics reveal another uncomfortable truth about who's actually buying these homes. First-time buyers now represent only 26% of home purchases, down from 40% a decade ago. The majority of buyers are either move-up buyers selling existing homes or investors paying cash. Young people trying to enter the market are competing against buyers who already have equity from previous properties or investment groups with unlimited capital. Those cash buyers have a massive advantage that goes beyond just closing speed. When you're financing a purchase, you're at the mercy of the appraisal process. If the house appraises for less than your offer price, you either need to bring additional cash to closing or renegotiate the deal. Cash buyers don't care about appraisals because they're not borrowing money from a bank. They can overpay by $50,000 without affecting their ability to close, which makes their offers more attractive to sellers even when competing bids are technically higher. The math gets even more brutal when you factor in the monthly costs beyond the mortgage payment. Maintenance and repairs average 1% to 2% of the home's value annually. On a $500,000 house, budget $5,000 to $10,000 yearly for things that break, wear out, or need updating. That's another $400 to $800 monthly that doesn't show up in your mortgage calculator. Add utilities, which run higher in houses than apartments, and you're looking at another $300 monthly depending on climate and home efficiency. This is where the income requirements start feeling impossible for average earners. You need $140,000 to qualify for the mortgage, but you actually need closer to $160,000 to comfortably afford all the real costs of ownership without being house poor. And being house poor isn't just uncomfortable, it's financially dangerous. When you're stretching to afford a house payment, you eliminate every financial buffer that makes life manageable. One unexpected expense becomes a crisis because there's no cushion. Your car needs new tires? That's going on a credit card at 24% interest. Your kid breaks their arm? Hope you like payment plans? The water heater dies? Better start shopping for personal loans. This is the reality for millions of Americans who technically qualified for their mortgage, but can't actually afford their lives. Banks don't care if you're financially stressed. They care if you make your payment. Those are completely different standards. You could be drowning in credit card debt, skipping doctor appointments because you can't afford the copay, and eating rice and beans for dinner every night. But as long as that mortgage payment clears each month, you're a successful homeowner by their metrics. The human cost of being house poor extends beyond just financial stress. Relationships deteriorate when money is constantly tight. Career flexibility disappears when you can't afford to take a pay cut for a better opportunity. Health suffers when you're choosing between paying bills and buying decent food. The house you bought to improve your quality of life becomes the anchor dragging down every other aspect of your existence. Geographic mobility becomes impossible when you're locked into a mortgage you can barely afford. Job offer in another city? Can't take it because selling would trigger transaction costs you can't cover. Want to relocate closer to aging parents? Too bad, you're trapped until your financial situation improves or until you've built enough equity to make selling viable. That beautiful house you bought has become a very expensive prison. Now let's address the wealth transfer happening in plain sight. When housing prices increase faster than wages, existing homeowners build wealth while potential buyers get priced out entirely. Someone who bought that same $500,000 house 5 years ago for $350,000 just gained $150,000 in equity by doing absolutely nothing except continuing to live there. Meanwhile, the person trying to buy today needs an extra $30,000 for the down payment and will pay significantly more in monthly costs for the same property. This creates a self-reinforcing cycle where home ownership becomes increasingly concentrated among people who already own homes. They sell one property, use the equity for the next purchase, and maintain their position on the wealth-building escalator. First-time buyers without existing equity are trying to jump onto a moving escalator that's accelerating away from them. Each year they spend saving for a down payment. Housing prices increase faster than their savings grow, pushing the goal further away. The investor class has figured out this mathematical reality and is buying residential real estate at unprecedented rates. Why wouldn't they? Houses are appreciating assets that generate rental income and offer tax advantages. Institutional investors can pay cash, close quickly, and outbid individual buyers who need financing. They're not buying homes to live in, they're buying them as portfolio assets, which removes more inventory from potential owner-occupants and pushes more people into the rental market. This dynamic is particularly brutal for people earning solid middle-class incomes who still can't compete. A household making $120,000 annually should theoretically be comfortable and building wealth. Instead, they're getting outbid on starter homes by investors paying $50,000 over asking in cash. That family watches their rent increase annually while their dream of ownership gets further away, despite doing everything right by conventional standards. Student loan debt adds another layer of impossibility to this equation. The average borrower carries $37,000 in student loans, with monthly payments around $400. That payment directly reduces their borrowing capacity for a mortgage. A person with no student loans who earns $80,000 qualifies for a larger mortgage than someone earning $100,000 with student debt. The education they pursued to increase their earning potential actively prevents them from buying a home. Medical debt creates similar problems. Unexpected health issues can derail homeownership plans instantly. Someone diligently saving for a down payment gets hit with a $15,000 emergency room bill. Their credit score drops. Their savings get depleted. Their mortgage qualification disappears. One health crisis transforms a potential homeowner into someone who will rent for another 5 years while rebuilding their finances. The credit score system itself functions as a wealth barrier disguised as a risk assessment tool. Miss one credit card payment because you were between jobs? Your score drops 100 points, which increases your mortgage interest rate by a full percentage point, which costs you an additional $300 monthly on a $500,000 loan. Over 30 years, that single missed payment costs you $108,000 in extra interest. The system is brutally unforgiving to anyone who experiences financial turbulence. Income volatility affects more workers than ever before as traditional employment gives way to contract work and gig economy jobs. Someone earning $150,000 annually as a W-2 employee qualifies easily for a mortgage. Someone earning the same amount through freelance contracts gets treated as high risk and faces additional scrutiny, higher rates, or outright rejection. The stability of your income stream matters more than the amount, which discriminates against entire categories of workers who earn good money but lack traditional employment structures. Here's what nobody mentions when they talk about the American dream of homeownership. It was only achievable for a brief historical period under specific economic conditions that no longer exist. In the 1950s and 60s, housing costs were 3 times annual income. Today, they're 7 to 8 times annual income in most markets. Wages haven't kept pace with housing appreciation, and they're not going to. The math that made homeownership accessible to the middle class has fundamentally broken. The people who can afford $500,000 houses today are either high earners in the top 20%, people with existing home equity, or those receiving family wealth transfers. If you're a regular person earning a regular salary without inheritance or existing assets, you're increasingly locked out of ownership in any desirable market. That's not a temporary condition or a market cycle. That's the new permanent reality of American housing. The solution most people propose is to move somewhere cheaper, which sounds reasonable until you examine what you're actually trading away. Sure, housing costs drop when you relocate from San Francisco to Boise or from Boston to Birmingham. Your mortgage payment might decrease by half, but your salary usually decreases too, often by a similar percentage. The cost of living adjustment works both directions, and employers know exactly how much less they can pay you in lower-cost markets. Beyond the financial calculation, moving to a cheaper area means leaving behind your professional network, which is often your most valuable career asset. That collection of industry contacts and relationships you spent a decade building? Gone. You're starting from scratch in a new city where nobody knows your work, your reputation, or your capabilities. For many professionals, especially those in specialized fields, that network represents the difference between career advancement and career stagnation. The just move advice also ignores that cheap housing markets are cheap for specific reasons. Limited job opportunities, declining industries, inadequate infrastructure, underfunded schools. The places where housing remains affordable are often the places where economic opportunity is disappearing. You're not solving your financial problems by moving there. You're just trading one set of constraints for a different set. Some people suggest house hacking, which means buying a multi-unit property, living in one unit, and renting out the others to cover your mortgage. This works brilliantly if you can qualify for the mortgage in the first place, and if you want to be a landlord while also being a resident. Most people dramatically underestimate how much work managing rental properties actually requires, especially when your tenants live in the same building. One bad tenant can turn your house hacking strategy into a nightmare that costs you money instead of saving it. Others recommend manufactured homes or mobile homes as an affordable entry point into ownership. This ignores that manufactured homes typically depreciate rather than appreciate, making them more similar to buying a car than buying real estate. You get housing, but you don't get the wealth-building component that makes homeownership financially advantageous. Plus, you often don't own the land underneath the home, which means you're paying lot rent indefinitely while your asset decreases in value. The tiny house movement gets promoted as another solution, but zoning laws make legal placement nearly impossible in most areas. You can buy or build a tiny house relatively cheaply, but finding somewhere you're legally allowed to put it presents an almost insurmountable obstacle. Most municipalities have minimum square footage requirements specifically designed to prevent tiny houses, and the few places that allow them are usually rural areas with limited employment options. Co-housing and cooperative ownership models offer some promise, but remain rare in America compared to Europe. These arrangements let multiple families share ownership of a larger property, splitting costs and maintenance responsibilities. The problem is finding other people you trust enough to legally entangle your finances with for decades. One family defaulting on their share can jeopardize everyone else's ownership stake. The fundamental reality facing anyone looking at a $500,000 house in 2026 is this: affordability isn't determined by what you want or what you need. It's determined by cold mathematics that don't care about your circumstances. You need roughly $140,000 in household income with minimal debt, excellent credit, and $100,000 cash sitting in your account. Anything less means you're either stretching dangerously thin or you're simply not qualifying at all. The housing market didn't break accidentally. It broke systematically through policies that favor existing wealth over earned income, investors over individuals, and capital over labor. Understanding these numbers won't make a $500,000 house suddenly affordable, but it will stop you from destroying your financial life trying to force something that the math clearly shows is impossible. Sometimes, the smartest financial decision is recognizing when the game is rigged and choosing not to play until the rules change in your favor.